In 1850, most British railway companies collapsed despite building technology that genuinely transformed the world. The railway succeeded. The railway investors did not. And right now, that exact pattern is playing out in artificial intelligence. We're watching $1.15 trillion flow into AI infrastructure over 3 years. Foundation models valued at 70 times revenue. Companies spending half their income just to keep the lights on. And beneath the headlines about transformation, there's a specific economic pattern emerging, one that's appeared twice before in the last 180 years, and both times it ended the same way. This is Economic Pattern Vault, where we break down financial history to understand how markets actually work by studying how they fail. Each video uncovers the repeating patterns behind economic booms, debt cycles, and power shifts, so you can see what's happening beneath the headlines. If you find this breakdown useful, like the video, subscribe to the channel, and share your thoughts or questions in the comments. Let's start with 1840s Britain. Railway mania gripped the nation with the same intensity we're seeing around AI today. The technology was genuinely revolutionary. It cut travel time between cities from days to hours. It connected markets that had never been connected. It was real innovation with real impact. But here's what happened to the money. Railway companies were trading at 50, 60, sometimes 100 times their actual revenues. Investors weren't buying shares based on current profits or even near-term projections. They were buying based on assumptions that every railway would connect every town, that demand would be infinite, that competition somehow wouldn't matter. By 1850, most of those companies had collapsed. The survivors spent decades working off debt from the boom years. The technology succeeded brilliantly. The bubble did not. Fast forward 150 years. March 2000. The dot-com bubble reaches its peak. Companies with zero revenue are valued in the billions. Pets.com promised to revolutionize pet food delivery. Webin would transform grocery shopping. The assumptions were nearly identical to railway mania. Every internet company would capture enormous markets. Customer acquisition costs didn't matter. Profits could wait indefinitely. When the crash came, it erased $5 trillion in market value. It took 15 years for the Nasdaq to recover. Again, the internet succeeded. The bubble did not. Now look at artificial intelligence today. The parallels aren't perfect, but the pattern is unmistakable. OpenAI hit a $500 billion valuation in late 2025 against projected annual revenue of $12 billion. That's roughly 70 times revenue. Anthropic reached $183 billion with multiples above 40. Perplexity, a smaller AI search company, trades at approximately 90 times revenue. For context, established profitable software companies trade around 6 to 7 times revenue. The AI premium is 7 to 10 times higher than proven business models that actually make money. And here's the critical detail. OpenAI, despite its dominant position, is projected to remain unprofitable through 2030. Some analysts suggest a funding shortfall exceeding $200 billion. The company's annual cloud computing costs, around $60 billion, dwarf its revenue. But individual valuations tell only part of the story. The real scale becomes visible when you zoom out to infrastructure. Amazon, Microsoft, Google, Meta, and Oracle are projected to spend over $600 billion on infrastructure in 2026 alone. That's a 36% increase from 2025. Roughly $450 billion of that targets AI-specific infrastructure: GPUs, data centers, networking equipment, cooling systems. Goldman Sachs projects total spending from 2025 to 2027 will reach $1.15 trillion. That's more than double what was spent in the previous 3-year period. These companies are now spending between 45% and 57% of their revenue on capital expenditure. That's not software company behavior. That's utility company behavior, the kind of capital intensity you see in heavy industry. And to fund it, they've shifted to something new: massive debt issuance. In 2025 alone, big tech raised $108 billion in debt. Projections suggest the sector may need to issue $1.5 trillion in new debt over the coming years. The assumption behind all this spending is straightforward. AI will generate massive returns that justify the investment. Here's the repeatable pattern that appears in railway mania, the dot-com bubble, and now AI. First, Revolutionary technology emerges with genuine, transformative potential. This part is real. Railways transformed transportation. The internet transformed communication. AI is transforming knowledge work. Second, investors extrapolate current excitement into infinite future growth. They assume every company in the space will succeed, that competition won't compress margins, that infrastructure costs won't matter. Third, capital floods in faster than revenue models can prove themselves. Valuations detach from current economics and start pricing in perfect execution over decades. Fourth, the gap between infrastructure spending and actual productivity gains becomes visible. And this is where we are now with AI. A PwC survey found 79% of companies are leveraging AI in some form. That sounds impressive. But when executives are asked about actual productivity gains, the answers change. A survey from late 2025 found that nearly 90% of executives said AI had no measurable impact on productivity at their firms over the previous 3 years. Not modest impact. No measurable impact. Research from the Penn Wharton budget model projects AI will boost productivity growth by less than 1/10 of a percentage point in 2025, rising to about 2/10 of a percentage point by the early 2030s before fading. That's not nothing. But it's not the revolutionary leap that current valuations price in. The software development sector offers the clearest example. Early studies from companies selling AI coding tools reported productivity gains of 20% to 55%. Those were the headlines. But independent research tells a different story. A study by a nonprofit model evaluation organization found that while experienced developers believed AI made them 20% faster, objective testing showed they were actually 19% slower. Data from developer analytics firm GitClear shows engineers producing roughly 10% more code since 2022, likely due to AI assistance. But that same data reveals sharp declines in code quality metrics. More code isn't necessarily better code. And a Stanford study from late 2025 found that employment for entry-level software developers aged 22 to 25 fell nearly 20% between 2022 and 2025. AI is having an impact, but that impact isn't translating to sustained productivity gains that justify current spending levels. There's another constraint emerging that has no precedent in previous bubbles: physical infrastructure limits. AI data centers require enormous amounts of electricity. Some proposed facilities are requesting more than 5 gigawatts of power, more than the peak load for entire metropolitan areas. PJM Interconnection, the largest U.S. grid operator serving over 65 million people, projects it will be 6 gigawatts short of its reliability requirements in 2027. In early 2026, the president of Independent Market Monitors stated the grid is at crisis stage. The problem isn't just total capacity, it's timing. An AI data center can be built in roughly 3 years. A large-scale power plant takes 5 to 7 years. The mismatch is creating bottlenecks that could physically constrain AI deployment regardless of investment appetite. And there's a political dimension. Residential electricity prices rose about 5% in 2025 and are forecast to rise another 4% in 2026. Analysis attributes $23 billion in increased capacity costs to data centers, costs that flow through to consumer bills. Senator Bernie Sanders has called for a moratorium on data center construction. Florida Governor Ron DeSantis, from the opposite end of the political spectrum, has expressed similar concerns. When the political left and right find common ground, that signals public opposition is broad and growing. With midterm elections in November 2026, this becomes a political issue, not just an economic one. Industry analysis suggests approximately 80% of companies calling themselves AI companies are essentially reselling access to a handful of foundation models, primarily OpenAI's GPT, Anthropic's Claude, or similar services. They're building thin application layers on top of someone else's technology. Their customer acquisition costs often exceed their lifetime customer value. They're competing on features that can be replicated quickly, and they're dependent on APIs whose pricing they don't control. This creates a pyramid structure. A few foundation model companies at the top backed by massive capital, thousands of application companies in the middle with minimal competitive moats, and users at the bottom still figuring out which use cases justify the cost. Venture capital funding reinforces the concern. In 2025, AI startups captured above 50% of all venture capital. That's not diversification. That's concentration. And history shows that when VC funding concentrates this heavily in a single sector, it often signals late-cycle behavior. Here's the critical nuance. This analysis doesn't suggest AI technology will fail. Railway companies failed, but railways transformed transportation. .com companies failed, but the internet transformed everything. AI will almost certainly transform knowledge work, automation, decision-making, and countless domains we haven't imagined. The question isn't whether AI succeeds. It's whether current valuations accurately price the timeline, adoption curve, and unit economics of that success. Whether investors buying today at 40 to 70 times revenue will see returns that justify those multiples. Whether the infrastructure being built today will generate sufficient revenue before efficiency gains make portions of it obsolete. If AI adoption accelerates faster than current deployment, if killer applications emerge that justify premium pricing, if productivity gains materialize at scale in the next 12 to 18 months, then today's valuations may prove prescient. But if adoption follows a more gradual path, if productivity gains remain incremental, if energy constraints bind, if regulatory costs rise, if competition drives down margins, then a reckoning becomes likely. Not in 5 years. Current spending rates, debt levels, and political pressures suggest 18 to 24 months. The pattern is clear. Revolutionary technology often succeeds while the first wave of investors does not. The gap between transformation and valuation is where fortunes are lost. The railway succeeded. Railway investors largely did not. The internet succeeded. .com investors largely did not. AI will succeed. Whether AI investors succeed depends entirely on the price they pay today for tomorrow's revolution. And right now, looking at valuation metrics, infrastructure spending running ahead of demonstrated productivity, energy constraints that could physically limit deployment, and a thin application layer dependent on a concentrated foundation, that price looks increasingly stretched. History doesn't repeat itself exactly, but financial behavior does. If this breakdown helped you see the pattern more clearly, like the video, subscribe to Economic Pattern Vault, and share your perspective in the comments. Understanding the cycle is how you stay ahead of it.